Hello and welcome. My name is Chris Can with Aspermont, and with me I have Phil George, who is Investment Manager with Entrust, part of the Euros Hartley setup. Welcome, Phil.
Thank you very much. Thank you, Chris. A pleasure to be here.
Great to have you. Silicon Valley Bank
Yes.
Collapsed very recently. It's
It has.
caused all sort of market upset. Can you give us a bit of a background in terms of what has actually happened there?
Certainly can, Chris. And you're right, global markets are probably off somewhere between 7 and 8% over the last day or two. A little bit of concentration there in the banking sector for obvious reasons. But essentially, so SVB is Silicon Valley Bank, which has collapsed over the last couple of days. In fact, I think it's Thursday, Friday last week it was confirmed to us. So Silicon Valley Bank, or SVB, is a bank based in Silicon Valley and has been around for about 40 years. And has spawned out of the success of the venture capital industry in the US, focused on tech startups essentially, many of which are now behemoths, as you know. And probably the first thing to touch on is the fact that this isn't unusual, and there is something like 4,000 or 5,000 regional banks in the US, and since 2001. About 12 or 13 of those on average goes bankrupt every year. Although this is kind of larger, we're talking about a $200 billion bank, which is probably the second biggest. But it doesn't get away from the fact that this is a bank that is really highly concentrated to one particular sector. And unlike the banks that we know and love here in Australia, they don't do lending. So they're a little bit exposed in some certain areas. So perhaps I can expand on that a bit.
Yeah, when you say collapsed, what has actually fundamentally happened that's actually forced that collapse?
Yeah, well, what's fundamentally has happened is that they've had to sell some assets to meet the demands of deposit holders who now want their money back, that there is now no equity value left in those businesses. And the dynamic, I think, is somewhat simple in the sense that, look, if you think about SVB that's been in business for 40 years, as I say, really successful business, but as the venture capital industry would raise money for these tech startups, that money would invariably find its way into SVB Bank, and they would put that on deposit for the companies so that they can draw on it over time to build the business. As that industry gets more and more successful, all of a sudden they're banking a lot of the executives. And before you know it, you've got really quite a large bank. Now, because they don't do any a diversified lending book, what they'll do is they'll put some of that money onto term deposit for the companies or the businesses or the individuals. Some of that money they'll also put out into the bond market to earn a better return. Now, when I say the bond market, I think something like 60% of the securities that the bank owned were what's called mortgage-backed securities. And unlike the mortgages that we have here in Australia, they're fixed rate mortgages. And because they're fixed rate mortgages, their value will rise and fall with the direction of interest rates. Okay. So because you've got central banks trying to get on top of inflation, interest rates have been rising, which means that a mortgage or a bond that was struck 2 years ago on a fixed rate return of 2%, the value of that needs to adjust to a 10-year bond yield, which is now 4%. So and the way the maths work is it's quite a significant devaluation of the asset, which is fine if you can hold it to maturity. But I guess that's the catch in all of this. So over the last 6 months, as the impact or the effect of these higher interest rates has started to bite the consumer, some of these technology companies based in Silicon Valley have said, you know what, we kind of need a little bit of that term deposit money back now because sales aren't what we'd hoped they would be, and we need to keep paying people and running the business. So you've got SVB that's sitting there saying, okay, yes, you can have your deposit back. And I think their withdrawals were running at sort of 17% over the last couple of quarters. So it was starting to look a little bit dicey for them. Last week or the week before, it got to the point where they needed to now sell some of these securities to make sure they had the cash to give back to the deposit holders. In selling those securities, they've had to take much lower prices. And I think they booked a loss of something like $2 billion in that process, which as an institution made them a little bit unstable. So they went to the market and said, look, this has happened. We kind of need $2 billion worth of equity funding. And the market kind of at that point said, well, what else don't we know?
Right.
And so that equity raising didn't get away. So they had to file for administration. So that's the dynamic of it, Chris.
Yeah.
And I guess, from there, what we've seen is that the US government or the US Federal Reserve have said to deposit holders in these banks, look, we're going to cover your deposits. So, don't worry about that. Don't feel like you need to line up and take all your money out. We'll look after you on the deposits. And that means that SVB or the administrators can now take a longer term view on these bonds and hold them to maturity. So that was, I think governments have learnt over time that you've got to act quickly and act hard when there's these contagion risks, particularly when it relates to financial industry. So we'd like to think that this is where it ends.
But you've talked about the huge number of banks that are in this regional space, and the fact that presumably they're all operating under similar parameters and regulations. And how many other banks would the markets now be looking at and thinking perhaps you're a potential risk as well in terms of that contagion outlook?
No, interesting question, Chris. Donald Trump, for all his successes, did actually raise the reporting threshold of the regional banks when he was in power from 50 billion to 200 billion in size. So in some respects, that's ended up exacerbating the impact of this particular one, because maybe what we've seen this week could have happened a year or two ago and it would have been smaller. But because you don't have to report this stuff until you're 200 billion, means that the bang is kind of bigger at the end of the day. But I think your point, Chris, is that I think this is potentially I don't want to say the start or the beginning, but it's an obvious sign to me that these rapid escalation or raising of interest rates is starting to bite consumers and is starting to have an effect on certain industries. So, it's happened in tech, and I guess the way to think about this is, okay, where have the excesses been in this most recent business cycle? And if there's been one beneficiary of low interest rates, it's been the technology sector. Okay. So we probably shouldn't be surprised to see a little blow up in that sector, but it says to me, okay, what other industries are out there that are starting to feel the pinch? So we've seen this kind of first wave come through. Market, I think, is adjusted and is kind of okay with it, but don't be surprised at all if we don't see some flow-on effects. But I don't expect another GFC. But this is part of the cycle. Capital starts to readjust.
I think probably what most people will be wanting to know is what are those next industries that have been potentially a fraction excessive.
Yeah, you know what? In many respects, Chris, you don't find that out until it's obvious when it happens. Okay. But certainly technology, was the obvious one. But I guess there's a whole range of other industries that can be impacted. But it's important that we understand the difference between the highly regulated, high capital requirement banks that we have in Australia versus these regional banks, which have always been, unregulated and highly dependent on the success of not just a region, but often an industry as well.
So if we take it as read that it's not going to be another global financial crisis, where does it stop for the regional banks in the US? Where's the backstop?
Well, I think the backstop comes if we can, if the US Federal Reserve decide that they've moved hard enough and quick enough on interest rates, and they at least signal to to markets that we're kind of almost done here. We may be pausing and then finally cutting. So when that happens, that should take the financial pressure off. But as much as anything, it's about sentiment. So when we reach that inflection point, companies and individuals will start to get back to work and start to spend, which will help all of us.
So are you making any practical changes in the way you're managing money at the moment as a result of the collapse?
Yeah, well, look, I think probably what it says to I think if we're getting towards the end of an interest rate hiking cycle, then the obvious target to me is to buy bonds. So buy US Treasuries in particular that have worn the pain of these high interest rates and are now finally at the point where you can pick up a reasonable running yield with the potential to pick up some capital growth at the back end once the Fed signal that we've stopped and potentially start to cut, because as we were talking about before, there's this inverse relationship between interest rates or yields, if you like, and how the bonds are actually valued. So that to me seems like a pretty good risk-adjusted way to start to allocate your portfolio. It doesn't mean we're wholesale selling stocks, not by any stretch, but where there are opportunities to reduce and reallocate to other parts of the portfolio like bonds, it's a good time to do it. Chris, I'd also add to that by saying that some other asset classes, might be a good place to be. So currently in our portfolios, we're allocating around about 8% of our money to gold, and I think whenever we step into these uncertain periods, where we're starting to effectively stare down, potentially a global recession in the face, money's going to go to those traditionally, sectors that allow people to hold value, and gold's the obvious one to that. So we're looking for opportunities to add to our exposure to that space. We were just talking earlier, how do you get exposure to that? Well, look, we're always going to hold some really good high quality exposures, but the producers. But gee, there's some opportunities at the small end. We were lucky enough to have exposure to a few of those last week with our conference, so I think if we can mix our portfolio with some juniors that look to have some good ground with some really good managers who can be up the production curve within the next 2 or 3 years, and mix that, I guess, with some of the lower cost producers, because we know how tough it is in this market with costs. Then I think we'll get a pretty good result for clients.
Phil George with Entrust Wealth Management. Thanks for your time and
Chris,
explaining that for us.
Thank you.